Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. You are tuned into a double video. And what do I mean? Well, this video is for the weekly market review and outlook, which is produced every Friday, but today I'm doing it on Saturday. And this video is also going to be shown on Tuesday for the show On Trend. So here's what we're going to talk about today. We're going to have end of week charts. So we got the complete week. We're going to do a performance overview. We'll see if the S&P 500 is ripe for a correction and what that target might be. I don't see a double top in QQQ. Small caps are doing just fine. So is healthcare, technology, and consumer discretionary. The ones to worry about or watch closely would be industrials and finance, and that's been the way the last couple of weeks. Energy is stuck in kind of a rut. Materials are kind of failing and looking weak. Bonds are surging. And then, of course, we'll finish with the industry group ETFs. All right, so we're going to start off with a little performance overview. We saw a bit of risk-off action creep into the market this week. You can see that the S&P 500 was down a fraction for the week. So, we had that big move down on Friday, which wasn't that big of a move, really. We'll see that in perspective. But the risk-off came in bonds, which surged 1.2%. And then you can see oil fell a little bit. Copper continues its slump. We can see the dollar rose about 1.23%, and that strength in the dollar could be weighing on large caps and helping small caps. And then gold was down a little bit. Now, what's interesting, if you go down and you back this perf chart and we do a year-to-date perf chart and we look at this action, look at copper's down 16.9%, oil's up 17%. So clearly a discrepancy there between commodities. Oil and the energy complex remains strong, sans natural gas, but base metals just remain really weak. Now, when we look at the major index ETFs this week, there we can see that the S&P 500 is down, the S&P 500 equal weight was down, and the S&P 400 mid cap was down, but small caps here were up. So small caps can continue to show strength, and IJR did hit a new high this week. When we look at the sector performance over this past week, we can see that some of the defensive sectors like consumer staples were weak and utilities were weak. And we had a little bit of strength in consumer discretionary and technology. But the finance and industrial sectors pulled back, and they have kind of started to fail at their resistance levels that we're going to focus on later. And then when we look at the industry group ETFs, we can see strength coming in XRT. So retail was strong, and that was helping the consumer discretionary sector. We got a bounce in housing, and I'll cover ITB later when I look at the industry group ETFs. And we also got a bounce in internet. But we have weakness in REITs, and that could be because bonds surge and base metals continue to disappoint. So they are clearly not on trend when I look at XME, that chart, and I think that is weighing on XLB, the materials SPDR. All right, we're going to start off with the S&P 500, which is, of course, my benchmark for the market. And as long as the S&P 500 is doing fine, 50-day EMA is above the 200-day EMA, I think we're in a bull market. I covered that in my presentation yesterday at ChartCon. And you can see here on Friday we had this really big drop. Well, if you look at it, it's like 0.71%. And David Keller in his presentation at ChartCon showed a chart of the Hang Seng. And it had what, the Bloomberg headline said it plunges. And then you look at the chart, and in relative terms, it doesn't look all that bad. And then Dave did a really good analogy where he showed that, they asked like a dozen analysts what was the reason for the plunge, and you got 15 different answers. So the truth is nobody really knows what is behind the market movements until after the fact. Now, on this chart, what we want to focus on is basically the bigger trend. And we had the correction period from January to April, and then we got the breakout there in May. And ever since then, we've been moving higher, and that is the trend that we need to be focusing on as far as this chart is concerned. That is not a new high. And I am not calling this January high resistance because I think the trend is up. And in an uptrend, I expect resistance to be broken, or the prior high, which isn't resistance. I expect the prior high to be broken. Now, as far as support, I got some shorter term support levels coming up next. But, you know, this zone here where you have the breakout area, and then you have the May, June lows and that rising 200-day EMA. So I'll just put a zone around 2650, 2700 and call that my long-term support level. All right, if we break through 2650, then we got some serious issues with the S&P 500 and the market. But until then, I would treat pullbacks as corrections and potential opportunities, not threats. So this next chart shows SPY in the top window. It is a line chart, and I added a dot moving average to kind of highlight the closes there. And the one candlestick chart down here below is the E-mini, just to kind of get a different perspective on the S&P 500. And both of these are quite, obviously tradable. The SPY is more towards the retail trader, investor, and the E-mini is, of course, for commodity traders, institutions, and such. But we can see here a breakout there. There was resistance, and we broke out, and this area kind of turns into the next support zone. And you can see if we pull back to that area around 2277.5, that would be about a 50% retracement of this advance from late June to early August. And that's a pretty normal pullback. That's 2 steps forward, 1 step back. And so if we get into that, say, 278, 280 area, then I want to be on alert, all right, for a potential bounce and a continuation of the uptrend. The E-mini is a little bit different. I mean, these are two different instruments. They're tracking the same thing, but you can see, resistance turning into support. And there's actual test of support in late July. So, the E-mini could pull back to that 2775 area maybe. And no, I wouldn't be worried about a support break. The main thing I would be worried about is if we break the support I showed you on the long-term chart. All right, but you never know how far a pullback will extend, but these are my first levels to watch if we do get a pullback, because we could get some backing and filling, because SPY had this nice move from 270 basically to 286, so a little pullback or backing and filling would be perfectly normal. All right, now we look at QQQ. There's probably going to be a little bit of chatter about a double top, because we come up to this 182.5, 183 area twice, and then we get this gap down on Friday. So the gap, okay, it's short-term negative, short-term bearish, but there's still a bigger uptrend at work here. And I think double tops are bigger. They're like distribution patterns. And, this pattern covers barely a month, and we're not even back near this prior low. And I think even if we broke this prior low, I don't think that would be a long-term bearish signal. I think it would just set up the next mean reversion opportunity, maybe in that 170, 172 area. And one thing I would recommend you do is you go back and you look at an uptrend. Look at some long uptrends, all right? Go back and look at a lot of long uptrends. Go back and look at the one from 2016 until now. Look at the one in 2014, 2013 and 14 in, say, SPY, and see how many potential double tops you see. Because every time you come near the prior peak and you come down, everybody starts saying double top. Well, a double top needs to be confirmed with a break below the intermittent low, okay, at the very least. Okay, so there are going to be a lot of potential double tops, and most of those potential double tops are never going to materialize into actual reversals. There is a bigger chance that the trend will continue instead of reverse, and so that's why I'm not focused on this double top. Now, as far as I'm concerned, maybe it did trigger a chandelier exit sell signal, and you get out of your short-term position, and you wait for the next pullback to get in for a mean reversion setup. But as far as the longer-term trend is concerned, I would not become concerned unless we break below this support zone here, and we'll call it 166. Now, the next chart we have here is IJR, and as I noted, it hit a 52-week high there this week, so it is clearly the leader. Also, the small cap index, dollar SML, hit a 52-week high. This chart, of course, it will include dividends. It's dividend adjusted data, IJR. And SML is not dividend adjusted, just like the S&P 500, SPX. So the fact that SML hit a new high and SPX did not tells you right there that small caps are still leading. And as I noted, the dollar hit a new high with a big surge this week. That might be part of the risk off trade that was active part of the week. I heard there was some stuff going on in Turkey, but I really don't pay attention much to that because I'm really focused on the evidence. What is the chart telling me? Okay, try to filter out that noise and focus on the chart. And a 52-week high is clearly bullish. Now we can see that little flag breakout and that surge in June. That was the last signal in late June. And then we kind of moved into that consolidation period. And it's just telling you there's a stalemate between buying pressure and selling pressure. And now the buyers are starting to get the upper hand again with that little breakout. Even if we were to break down below 84 even, I wouldn't turn that negative on IJR. It would just set up the next pullback, which would be an opportunity. Now, there are a number of ways to measure leadership, and I can see 3 different ways to measure leadership in consumer discretionary, XLY, technology, XLK, and healthcare, XLV. All right, first up for healthcare. Over the last 3 months, it's up 10%, and it is leading the 9 or the 10 now with real estate, the 10 sector SPDRs. And I think 3 months is a pretty good period. And if you look at the chart, it's got a breakout. So healthcare is one of the leading sectors right now. Now, if we back this out and we look at year to date, of course, we get a different picture with the sectors. And we can see that the 2 leading sectors here are going to be technology and consumer discretionary. So they're up around 15%. So year to date, they are leading. And if you look at the price chart, XLY hit a 52-week high this week, and retailers are also strong. And so that is a strong sector as well. So healthcare, technology, and consumer discretionary, I think, are the 3 strongest sectors right now. And they account for about 53% of the S&P 500. So that is enough to keep the market afloat at least. Now you can also see on this year-to-date chart that the financials SPDR XLF is up like 1%, and the industrials SPDR is up like 0.01%. So these are the 2 ones that are still dragging on the market, and they're the ones I'm going to focus on as far as the charts are concerned, because they could make or break this market and lead to a deeper correction or to a new high if they break out. So the finance and the industrials SPDR have pretty much identical chart setups. We'll look at finance first here, and you can see you have this massive advance, all right, and then you have a long correction. And this correction still retraced around 50 to 62%, which is normal for a correction. Especially after a big advance, you're entitled to a rest. And, things were looking kind of bleak here, but we firmed and we got that breakout there with that surge into early July. And we continued higher throughout July and early August. And we actually exceeded this high. And then we fell back with that gap on Friday. And as with the gap in the S&P 500, sure, it's a short-term negative, but it doesn't affect even the short-term uptrend or upswing that I've marked here with the rough regression channel and this support here. I'm just going to give a little buffer and mark it at 27.5. Probably don't even need the rough regression channel there because I can see a low, and if we break that, then we have a short-term reversal, and that would be negative. Okay, that would be something to consider. But I don't think this gap down is worth considering just yet. Because actually, we did exceed this high. So I think there are more positives than negatives on this chart unless we close below 27.5. Then we have to rethink it. All right, so here is the industrials SPDR. And again, you can see that similar setup as with XLF. There's the big advance. And then we have the big correction that looks like a wedge of sorts. And, we found support from these February, May, April lows and into June, those lows. And we got the big surge in July. and we poked our head above resistance here, but this little breakout didn't hold. Now, are we saying it's a breakout failure and this gap down is bearish and I'm totally revising everything I've said? Well, no. I mean, I'm going to allow for a little bit of volatility. I'm going to give it a little bit of wiggle room. All right. Technically, we have a higher high here. Actually, we have a higher high from April to May and now from June to July here. So we've got some higher highs working here, and we're still got an upswing. And, you know, maybe this is going to be like a little flag or something, this 2-week decline or so, and look for a breakout here. But I'm not going to become overly concerned unless we close below 74. All right, if we do that, if finance and XLI industrials here break or reverse their short-term upswings, then I think we could see that deeper correction in the S&P 500 and that pullback like to that 278 area I showed on the chart earlier. Now, of course, the upside is we continue higher, and I've got a bullish bias on XLI and XLF right now. So I'm expecting them to continue higher. I'm just giving you the levels that I have to reevaluate. All right, so now we're going to turn to energy, and energy is still one of the more interesting sectors, and also the XES, which I'll do next, because oil's still in a long-term uptrend, which I'll do as well. But if we see XLE here, we can see a big cup with handle still taking shape. Now, this consolidation has gone on a little longer maybe than I would have liked. I would have liked a breakout, you know, at 79 in early mid-July. But instead, we're still messing around here in this consolidation, and we got a lot of support in the 73, 74 area. So, you know, if you want to micromanage it within that consolidation, look for a little breakout there around 77 to get your early entry. And then, of course, a break above rim resistance would be bullish and signal a continuation higher. And if you just look at the right half of the pattern, you see a big advance and kind of like a triangle consolidation there, and a breakout at 78 would be bullish. But I still have a bullish bias on XLE. You know, it hit a 52-week high there in May, so I would be more inclined to expect an upside breakout here. Now, XES has been a little bit more of a problem child, if you will, you know, where XLE is back up here near these highs and consolidating. XES fell back and then consolidated here. And, you know, we got the first bounce off support, but we came back and tested support. We got the second bounce, and now we got something interesting and playable because we have a little consolidation there around 16.5, 17. And if we get a breakout there out of that consolidation, that's the early signal that we're going to challenge these highs. And so I give XES a bullish bias as well, simply for the fact that, you know, this is a 52-week high. We still got a bit of an upward drift here. We're in the upper half of the trading range. So I would expect an upside breakout. And if we close below 16, then I have to totally reevaluate this bullish bias. Now, looking at oil, clearly the long-term trend is up because you have nothing but higher highs and higher lows. And you had a 52-week high there in late June, early July, probably late June there. It doesn't really matter. It's a higher high and it's a 52-week high. And there's your last significant low in June, and we're just above that low. So, you know, the lows from June and July now and maybe August here mark a clear support zone in that 64, 66 area. We got the 200-day EMA coming in there as well. That's not a clear-cut support level, but it is a level to watch because if you get below that, then you have maybe the odds for a bigger downtrend taking shape. But right now, I treat this pullback as a pullback within a bigger uptrend. And you can see RSI is around this 40 area, so it's mildly oversold, and oil's trying to firm. I guess the first place to watch is 70 for an upside breakout. And if that happens, that would, of course, be quite positive for XLE and XES. But a close below 64, and we have to reevaluate. All right, now we'll turn to basic materials, and this one's turning into a bit of a frustrating ETF. You know, if I had to pick the promising ETFs, well, of course, technology, consumer discretionary, and healthcare are the leaders. We have finance and industrials on the verge of breakouts and showing some promise in XLE also. And then, materials is probably way down on the list as far as sectors that I'm interested in. Because if you see here, you can see we got this breakout and things were really looking up, but then we had a sharp decline and then we started struggling to get up, and now we've had a sharp decline. Now, I still have a bullish bias because, after this breakout, we've got support in that 57.5, 58 area holding. But if we close below 57, then I think that's going to be a bearish development for materials. And I'm also seeing some weakness in metals and mining and in steel. So, anything that's hard and you drop it and it hurts your foot, I'm staying away from. Oil, you drop it, well, you get a messy foot. But, gold you drop, copper you drop it on your foot, it's going to hurt. So I'm staying away from most of this stuff right now. Now we're going to turn to the bond market because there's some interesting stuff happening in the bond market. And it didn't just start, on Friday. It's been going on for about a week and a half. It still hasn't affected the bigger downtrends in IEF and TLT, but you have to wonder if there's some sort of a basing process going on here in the bond market, because we had a 52-week low there in May in IEF and in TLT. So the long-term trend is down. You can see there's the 200-day sloping down, and prices are below the 200-day. But, we've been around this support zone, if you call it, support in a downtrend, around, 117, 119 since February. All right, if you look at IEF, maybe there's some sort of inverse head and shoulders. Of course, I was highlighting that right here in mid-July, and we proceeded to break down. But now we've got this big surge. And this is interesting because bonds, if they break out, if IEF breaks out there at 103 and change, and TLT breaks out at 123, that's going to reverse a long-term downtrend in the bond market. So I think it's something to watch for right now. I don't like anticipating trend reversals, as you know that. I prefer to play the continuation move. But we had a continuation move here in July with that breakdown, but it looks like it's failing and the bond market is having a rethink on that. And next we're going to look at a long-term chart for yields, and then we'll look at AGG. Now here's a weekly chart for the 10-year Treasury yield and the 30-year Treasury yield. And we can see that there's a long-term uptrend working here. But we can also see that that 10-year yield has stalled in that 2.8 to 3% area. That's 28 and 30 on the chart. And the 30-year yield has stalled between the 3 and 30% area, which is the 3 and 3.2% area, which is 30 or 29.5 and 32 on the chart roughly. But basically bonds yields have gone nowhere since February there. And that's interesting because the stock market has gone up. So the fact that yields are stalling out is interesting. And if we break down here both support levels, then that is going to be telling us that yields are going lower. And if yields go lower, we have to reassess things, because yields moving lower would suggest that maybe the economy is not as strong. Now, I don't want to read too much into something that hasn't happened yet. You got to be very careful here. Right now, the trend is up and we have yet to break down. But if we do break down, we're going to have to rethink this. Now here is the Aggregate Bond Fund from iShares, and it's a bunch of different bonds put together. But it doesn't give you any edge because you can see the correlation with TLT is pretty much 1. You can see that correlation coefficient just stays at a relatively high level. So they're always moving in the same direction. But if you look at this chart, you can see also maybe an inverse head and shoulders pattern developing. And, we had the failure at resistance, so it looked like we were moving lower. But all of a sudden, we have this rethink, and we surge, and we're on the verge of breaking neckline resistance here that would reverse this downtrend in the Aggregate Bond ETF. So let's keep a close eye on bonds in the coming weeks. All right, now I'm going to go through some industry group ETFs, but I'm not going to go through all of them. The first one here is ITB. It's one of the weakest. It's in a downtrend, hit a new low for 2018 in July, so it's one to stay away from. But on the other hand, we have retail, and that's helping consumer discretionary. It hit a 52-week high this week and is getting that kind of triangle breakout. Now these technology ETFs are kind of in the same boat. Here's Sky, and it hit a new high and then it pulled back there, and now it's getting a mean reversion bounce, but it's a question of whether that short-term bounce is going to hold. I'm not looking at a topping pattern here, but if we move below 54, maybe we have some more backing and filling and consolidation with support there around 51, 52. And all these charts are in the Arch Charts chart list, which is available to subscribers. Hack shows a similar pattern. FDN, a bit of a weaker pattern. It's been edging lower, but still consolidating after a 52-week high. Networking is the weakest, so I just skip it. Now, semiconductors is one of the more interesting ones because, maybe there's a lower high forming here. Normally this gap isn't such of importance if you're hitting a 52-week high just before it, but here we have a potential lower high, and I'm still watching 180. If we break below that level for SOX, that's going to be a negative. Now we look at insurance. Insurance is one of the stronger ETFs because look at that breakout there, kind of stalling above the breakout, but it led in July and it led the finance group. So this may be a consolidation within an uptrend. We look at regional banks, we can see that they're really struggling, but still in an uptrend. I mean, this is still an uptrend going back to October to now. We had a correction and we got our mean reversion bounce starting, but now we started to flounder here. So if we go below 61, then that would call for a reevaluation of this uptrend. But right now, it's still a mean reversion bounce in play until we break below. If you're nervous, say 61, otherwise a buffer to 60. There's REITs pulling back after a wedge breakout. Now, Aerospace and Defense, I think, is one of the more interesting groups, too. It's been in a long consolidation after a new high. The consolidation started narrowing, and now we're consolidating around a breakout zone. So this one looks like it may be poised to move to new highs and lead. Airlines, I really don't like. TAN is in a downtrend. I don't like the transports that much. Biotech's volatile, but still in an uptrend. All right, there is a 52-week high. So we're in an uptrend, but it's getting really noisy in here. But I think you have to put your RSI. I'll put the RSI on that chart next time. But look for a pullback to play the uptrend here. And XBI is a bit of a different story because it's in a mean reversion bounce, but this bounce is stalling. And if you close below 94, then you have to reevaluate that bounce there because maybe we're going to go back to the 90 area. But that would still be within a longer term uptrend. All right, now we move to healthcare, strongest part of the market right now. IHF hitting a 52-week high. Medical devices just below their prior high, but still no downtrend here. Pullbacks are opportunities. We already went over XES. Coal is struggling to hold its breakout. Maybe a head and shoulders there, I'm not sure, but a break below that support at 15, and so would be bearish. MLP continues to perform well since that breakout there in the mid part of July, so hitting a new high intraday there. This is part of the reason for weakness in the materials sector. MOO, it looked like we had a breakout and then the gap down, but I still give the breakout the benefit of the doubt, and I put support there at 61.5 for now. Copper miners, don't even look at them because they're hitting 52-week lows. Stop looking at them when they had this breakdown there in June. Gold miners, 52-week low, don't even look at them. Stop looking at them when they had this breakdown there in June as well, and then 52-week lows now. And XME, I'm giving up on that one too. Lower highs in 2018 and a breakdown there, so staying away from that. And steel, I'm staying away from steel. It's a big consolidation. It's near the lows of that consolidation, but it is clearly not on trend. And so you kind of got a breakdown there. So that concludes this edition of On Trend and the weekly market review and outlook. As always, if you have any questions, comments, or feedback, there's my email, askarthur@stockcharts.com. Thanks for tuning in and have a great weekend or week.